And welcome back. I did an interview with Fox News last week. The reporter asked me a question. He says, "What is your housing market forecast for 2023? My answer for him was, it depends on the direction of mortgage rates this year, as well as incoming inflation data, which will impact the size of future rate hikes by the Fed. And speaking of that, Fed Chair Jerome Powell spoke today, and he said interest rates are likely to be higher than previously anticipated. This was published on CNBC's website today, which is March 7th. He also said here that the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. In other words, if incoming data comes in stronger than anticipated, such as a strong jobs report and of course inflation numbers which are not winding down, that would be a recipe for the Fed to increase rates more than anticipated. Therefore, as CNBC says here, the switch last month to a smaller 0.25 percentage point rate hike that we saw last month could be short-lived if inflation data continues to run hot. So for example, January's data showed that inflation, as gauged by the personal consumption expenditures prices, the preferred metric by the Fed, was still running at a 5.4% pace annually. That's well above the Fed's 2% long-run target. And according to Jerome Powell, we have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do, and the road there could be a bumpy one. After Jerome Powell's comments regarding that future rate hikes are likely to be higher than anticipated, the street is now forecasting that the Fed's going to increase the federal funds rate by 50 basis points in their next meeting, which, by the way, their next meeting is on March 22nd, which is 2 weeks from now. So by a 66.8% probability, the street is forecasting the Fed is going to increase the federal funds rate by 50 basis points to 5.25%. And now the street is forecasting that the Fed's only going to increase rates by a 33% probability for a 25 basis point rate hike. This is drastically different compared to yesterday. Here's yesterday's probability. So yesterday, the street was forecasting by a 71.6% probability that the Fed was going to increase rates by 25 basis points. Now they have forecasted that's going to be an increase by 50 basis points for a 67% probability. So in other words, the street was forecasting for a 25 basis point rate hike in 2 weeks yesterday, but after Jerome Powell's speech, they're now forecasting the Fed's going to increase rates by 50 basis points. After that, the Fed meets on May 3rd, and it's anticipated the Fed's going to increase rates by another 25 basis points to 5.5%. Then on June 14th, the Fed's going to increase rates potentially to 5.75%, another 25 basis point rate hike. So how does this all tie to our housing market? And here's the answer right here. Here's the 10-year Treasury, which of course is tied directly to the direction of mortgage rates. Right now, that's just under 4%. Today, which again is the 7th of March, the change here is more or less flat, a decrease of 1.5 basis points compared to yesterday, just under 4%. Also, have a look at this, because according to Investopedia.com, as of today, with people with exceptional credit, of course, average 30-year fix is at 7.04%. Also, according to the Mortgage News Daily, let me just update this. Yeah, according to the Mortgage News Daily, as of today, for a 30-year fix, it's at 7.03%, again, for people with great credit. This is not too much lower than the 12-month high that was set in October 20th last year, I believe, late October last year, when average rates were at 7.37%. And by the way, FHA is at 6.52%, VA is at 6.55%. So take a look at this, because again, right now, average rate's at 7.03% for a 30-year fixed. 1 year ago, it was 4.09%. That's an increase of almost 3 percentage points over the past 12 months alone. an increase of 294 basis points to be exact. Here's what we also know, because on February 2nd, rates on average are at 5.99%. Again, right now, rates are hovering around 7%. This means over the span of the last 30 days or last month, rates have increased by 1 percentage point. This causes a 10% decrease in buyers' purchasing power, which obviously increases your interest rate you pay for your home loan as well. So here's an example really quickly for you guys. Here's an update for you guys. So for someone looking to buy a $450,000 home, putting 5% down compared to February 2nd, when rates were about 5.99%, your average monthly housing payment of principal and interest would be $2,560 per month. However, based on today's rates of just over 7%, your new housing payment would be $2,853 per month. Therefore, compared to just 1 month ago, your average monthly housing payment, if you're looking to buy a $450,000 home, putting 5% down, has just increased by $300 more per month for that same house compared to just 1 month ago. And because of this, we have a lack of housing affordability in the US once again, which is likely to decrease home buying demand as well. Here's what we also know as well, because according to a new survey that was just posted today by Fannie Mae, they said housing sentiment returns to a near survey low amid housing affordability constraints and job security concerns. Also, both home buyers and home sellers express caution about current market conditions. So take a look at this. We kind of have this tug of war between buyers and sellers right now. So look at this, because here is new listings across all Redfin metros. Let me actually include 2020 here. So new listings. So new listings for the 4 weeks ended February 26 are down by 20.7%. We're seeing approximately 21% fewer new listings right now compared to the same time frame in 2022, and also below levels in 2020 as well as in 2021. They're in orange. So a decrease of new listings down by 21%, which is a common occurrence we've been seeing every single week this year. That's on the supply side. Let's look at the demand side. So according to Redfin for new listings, which is right here, so new listings in the US right now is down 15%. This is when a home seller accepts an offer from a home buyer. So new listings are down compared to last year every single week this year, and currently they're down by 15% compared to 2022. And again, just like new listings, contracts being signed between buyers and sellers is down compared to 2020 as well as 2021 as well. So to briefly summarize this for you guys, we're seeing home sellers pull out of this housing market, as we can see by a huge decrease of new listings, but also home buyers are also pulling back as well, as you can see this huge decrease of contracts being signed. And going back to Fannie Mae's survey here, it says their HPSI, or their Home Purchase Sentiment Index, decreased 3.6 points in February to 58, breaking a streak of 3 consecutive monthly increases and returning the index, or their HPSI, closer to its all-time survey low that was set in October of 2022. Now that's saying a lot because the survey goes all the way back until 2010. So in October 2022, they reached an all-time survey low regarding housing sentiment in the US. Fannie Mae posted here that in February, 44% of consumers reported that it's a bad time to sell a home, up from 39% last month. And 24% expressed concern about losing their job in the next 12 months. That's up from 18% last month. According to Doug Duncan, who's Fannie Mae's Senior Vice President and Chief Economist, he said the HPSI declined this month and is now just slightly above the survey low that was set late last year in October 2022. The decline was partially driven by a substantial decrease in consumers' sense of home selling conditions, with most respondents of that survey who indicated it's a bad time to sell a home, citing unfavorable economic conditions and mortgage rates as the primary reasons for that belief. Therefore, it appears that consumers on both sides of the transaction, buyers and sellers, remain cautious about the housing market. It says here, we believe these results corroborate our expectation for subdued home sales in the coming quarters, particularly now that mortgage rates have begun rising once again. So speaking of that, have a look at this. This is Fannie Mae's housing market forecast that they posted just about a few days ago. So for total home sales, which of course includes new as well as existing home sales, total home sales, they're forecasting for 2023 to decrease by almost 18% compared to 2022. For new single-family houses, they're expecting home sales to decrease by 5.4%, existing to decrease by 19.2% compared to 2022. So again, total home sales, a decrease of 18% compared to 12 months ago, whereas they're forecasting for huge decreases of existing houses down by 19%. And that's after a 17.9% decrease in 2022. It's also worth noting here that they're calling for a decrease of home sales in the US, but also decreases in home prices as well, based on their HPI or their home price index. Because starting in Q2 2023, they're calling for their HPI to decrease by 3.1% compared to the second quarter of 2022. And thereafter, decreases every single quarter compared to the previous quarter through 2024. In fact, for 2023, they're calling for their HPI to decrease by 4.2%. Then in 2024, it to decrease once again down by 2.3% compared to 2023. Speaking of home prices, have a look at this because according to Redfin, they actually just revised their median sold price for the 4 weeks ended February 26. Because compared to 12 months ago, it's a decrease of 3%. For the nation as a whole, the median sold price is down by 3% compared to 12 months ago. And as I reported to you guys last week, this is actually the first time since February of 2012 in which we had a decrease in home sold prices compared to 12 months ago. On top of that, at $342,000, the median sold price in the US, this is actually the lowest levels going back to more or less October of 2021, when back then the median sold price was also $342,000. Let me briefly repeat that because home sold prices are at the lowest levels going back to October of 2021. Also, check this out because this is something worth mentioning again, because if home sold prices remain flat through the spring months this year, let's say through June of this year, we're likely to see home sold prices to be negative by 12% by the time we hit June this year. This is because last year we saw a huge uptick in home prices during the spring home buying season. As you can see right here, this black line, home prices absolutely skyrocketed once we hit really February last year and skyrocketed all the way until we hit all-time record highs back in June or May and June last year when the median sold price was $388,000. So prices absolutely skyrocketed last year, whereas this year they're going exactly the opposite direction, going down. So to briefly kind of summarize today's video, it appears based on the statements from Fed Chair Jerome Powell, there's not going to be a Fed pivot anytime soon regarding a decrease in the federal funds rate, which would likely to cause mortgage rates to decrease. In fact, we're probably seeing just the opposite because the street is now forecasting that the Fed's going to increase the rates or increase the federal funds rate by 50 basis points in next meeting in 2 weeks, rather than a 25 basis point rate hike. And that 50 basis point rate hike by the Fed, as well as future rate hikes by 25 basis points over the next 2 meetings, which are expected, is likely to cause mortgage rates to remain elevated or high, which are likely to decrease home buying demand in the coming months. But what do you guys think? Please leave me a comment below. I'd love to hear from you guys. Also, of course, I appreciate you guys watching this video. Hope you guys have an awesome day and look forward to seeing you on the next one.